Last week, as anticipated, Jerome Powell and the Federal Reserve raised short-term interest rates by 0.75%. Remarkably, the next day, mortgage rates went down. Let me first of all tell you why that happened, and secondly, what the practical implications are. This gets a little bit wonky, but stick with me. So, the day after Jerome Powell raised short-term interest rates, the GDP numbers were released. The gross domestic product showed that the U.S. was probably heading toward a recession. When that happened, investors flocked to the 10-year bond, which is a relatively safe investment. Because they were flocking to the 10-year bond, the yield declined, and because mortgage rates actually follow the yield of the bond, well, mortgage rates went down. So what does all this mean in practical terms? Well, because interest rates have gone down a full point in the past month, it now costs less money to borrow and buy a house. If you're thinking about buying a $250,000 property, a 1% decrease in the interest rate means that you're saving $2,500 a year, about $200 a month. That's a lot of money. The second thing is that there are fewer people looking to purchase today than there were not more than 6 weeks ago. In other words, have you been on the sideline wondering when the best time would be to dive back in? Now is the time to do so. If you'd like to talk a little bit more about real estate, feel free to give me a call. My number is 330-8750.